Okay, why don't we just get started? Hi, everybody. It's Steve Glenner at IMN. I'd like to thank you all for joining us for the introduction and comparison of the next generation of home equity investment and loan products. It's a pre-conference virtual meeting, and it's a part of our of the IMN HEI and Home Equity Capital Market Conference, which will be in Austin, Texas, September 5 and 6. We have a wonderful group of experts lined up to address these topics, and I would like to thank them all for agreeing to share their expertise with us. Before I hand things over to Robert, the moderator, I'd just like to remind you that just submit questions throughout. You can submit questions throughout the webinar using the Q&A button at the bottom of the screen. So please do so as you see fit. We'll be monitoring this, and we'll ask audience questions throughout the webinar. So without further ado, let's get to the good stuff and hand things over to Robert Helms, who's the host of the Real Estate Guys radio show. Thanks, and I'll be seeing you on the other side.
All right. Thanks, Steve. And thanks to everyone for being here today. Super excited about the panel that we've assembled. And whether you're new to this segment of the industry or you're as seasoned as they come, I think you're going to learn something today. We've got just a stellar panel. And as the description said, the home equity investment market has just seen a huge amount of growth. And not only that, there's the traditional side of the market. For years, lenders have had tools to help homeowners and investors access the equity in their homes. But this entire industry has taken on a new life. So this particular panel is really designed to be an introduction to that and what's going on. And I think that you're going to find there are some very creative folks who are bringing new ideas, new services, new products that are going to challenge our thinking a little bit. If you've been in the real estate industry a long time, like I have, you're used to it working a certain way, and then, boy, some innovators come up with something, and I think there's going to be a ton that happens in the coming years here. So if you're not already signed up to join us at the conference by the end of this session, hopefully you want to come to Austin and hang out and learn more. But what I'd like to do as a way, rather than just introduce the panel each to you, I'm going to ask each of the panelists to give us a little background about what exactly it is that they do within the industry, and kind of, guys, if you can, the story of how you got there, why you think this is an angle. We'll get into more specifics after the initial round of introductions with how these various products and companies compare. But let's start out. I think we'll start out with David with Equify, because he is on the West Coast and my own stomping grounds, San Jose. So David, tell us about you and about what you guys are doing.
Sure, great. Happy to be here. Happy to see everybody. Looking forward to the conference down in Austin on the 5th and 6th. And thanks for choosing me first, because by coincidence, probably, we were the first, we developed the first what's now known as an acronym, HEI contracts. But I started the first version of Equify back in 2004. And little known is that product, or not that product, but a similar product, had been developed by a guy by the name of Nelson Schneider, who was an E.F. Hutton analyst that felt that home equity should be made available outside of the context of a loan. And, you know, we kind of differed, and he believed that if you're getting 20% of your home value, that you should only pay back 20% of the future value of the home. And I said, well, you know, no investor is going to do that. This product doesn't exist in the market. And so we actually worked with Morgan Stanley, started in like 2005. I think it was probably 6 or 8 months before Thomas Buhnholz created Rex, which is now Unison, and worked to get that product on the market until they fired the whole team at Morgan Stanley in October of 2007 as the housing crisis started. So, and, you know, for years, obviously, these investments were not, you know, on the radar for investors. But so I've got a long history in this, have a lot of market knowledge in it. Prior to that, you know, I was in the retirement space with my consulting firm, design most of the modern annuities today. And that's what led me to designing our product, was giving people an alternative to a reverse mortgage, which, back in those days, no bank would offer a reverse mortgage. So anyway, without taking up too much time, we have a suite of products. We have HEI. We have two new hybrid loan products we're introducing. We acquired a mortgage company, so we're now fully licensed regardless of what regulators do. And happy to be here and talk more about the questions.
Excellent. Thanks, David. That's a great overview. Kind of a good pattern for everybody here. Jim, let's go next to you. Jim's with Unlock. And same question. What are you guys doing in this space? And give us a little context as well.
Sure. Thanks. And hello, everybody. Happy to be here. Looking forward to seeing everyone in Austin. I'm Jim Riccitelli. I'm the founder, co-founder, and CEO of Unlock. Prior to that, I was the co-CEO for many years at Unison, which used to be Rex, what David mentioned. So I started in this industry in 2006, and we were the first to really launch a product into the market and do volume. The original Rex product became sort of the granddaddy that most of the other companies kind of drew from, because we scaled the business. We were the first to do a billion in origination, for example. But I go all the way back to that. I was at Rex or Unison from 06 to 2019. Left in the summer of 19 and started on Unlock in 2020 in partnership with Salutigrade, Ryan Kraft, who will be at the conference and has a wealth of knowledge. Salutigrade has been the preeminent purchaser of these contracts in the market, has bought more than any other single investor. But at Unlock, we do things a little bit differently. Most of the companies use an option structure underlying the contract, and we use something different, a forward sale structure. But the products are by and large more alike than they are unalike, the products that are out there in the market. But we're moving into the sort of phase two in the industry now, where capital was always the difficult thing to obtain for these, because Wall Street didn't understand the product, and you're out there competing with all the other asset-backed assets that are out there for purchase. And over the past couple of years, with an enormous effort, we've been able to create real investor awareness on Wall Street. At Unlock, we were able to get rating agencies to rate this asset for the first time. We were able to get financing from large banks, and so lots of folks are now accessing those tools, and this has really brought the industry forward. I mean, obviously, we have our own conference now for the first time as a result of this, because there is capital out there. All of Wall Street knows what this is now. They understand the investment value, and the consumers are starting to have awareness as well. So it's a very exciting time to be part of this industry.
Thanks, Jim. That's a great tee up. And it is in many ways edge of the spear, although it's great to hear you guys talking about working on this product and this type of product for more than 20 years. So that's how it works, right? It becomes obvious at some point. And hopefully the fact that IMN's doing this first conference is telling us that's where we are. Let's go to Nick with Home LLC. Nick, welcome. Tell us about what you guys are doing. It's a little different, especially your labor force. But tell us what's going on with you and kind of the context of what got you into this space.
Absolutely, Bob. Nick Shah. I'm the founder and CEO of Home LLC. I'm a third generation CEO. What's different about Home LLC than others is HEI is not all we do. We have a second division as well, where we provide analytics as a service to institutional real estate investors. And most of our workforce is global compared to everybody else. So we run the HEI business more as a family business, as a growing profitable business, rather than a venture funded hyperscale business, which is why our origination volume is not the same as some of our amazing, other players in the industry, like the ones you see here today. But we focus more on, essentially growth and scale. And like Jim mentioned, it was an interesting phase to be in the last 4 or 5 years in the HEI business, in the phase one of the HEI business, where all calls that we had with investors or potential customers, we would explain the basics of fractional home ownership or shared appreciation or home equity investments or home equity agreements. And it's really good to see this become into an industry and converge into now a more semi-standardized structure and converge into more of a product cohesion. And also very excited to be at IM in Austin in the first ever HEI conference. We probably had the first ever HEI panel in another conference just a few months ago. To have our own conference is a dramatic shift and an inflection point in the HEI thesis. And I was talking to somebody else who said, non-QM at their first ever conference just about a decade ago. And right now, the origination volume is pretty material compared to the overall RMBS market. So, that's essentially why most of us are in the home equity business. We see the massive market. We are all optimists, but we are also masochists to a degree, where we have essentially been through a tough journey so far to come here, and very excited for the next few years and decade in the home equity business.
Thanks, Nick. It really is a group of pioneers, so hats off for that, and it'll be interesting to see where it goes. Not too many industries kind of show up and have history and legacy, but their most maybe exciting days ahead of them. So cool stuff. Well, let's say hi to Jordan. Jordan's with Point, and tell us, Jordan, about what you're doing. I guess you're our first non-CEO member, but that's okay. Tell us about what you guys are doing and how it fits in.
Yeah, thanks for having me. And hey, everyone, my name is Jordan Fox. I serve as the head of investor operations at Point. I've actually been at Point for 7 years now, and I've done everything customer facing, now focus on our forward flow investor relationships. I've been all over the organization, oversaw our first 3 securitizations, which includes the first securitization of this asset class, which is a really great milestone. Looking forward to seeing everyone in Austin and connecting with everyone there. But what is Point? What is an HEI more broadly? So HEI and what we're originating at Point. So first off, HEI stands for Home Equity Investment. ARC uses the acronym a lot. And HEI allows a homeowner to get cash out of their home in exchange. We share in the home's future appreciation or depreciation. So there's no monthly payments. There's no interest rate. It is secured against the home, and we have a 30-year term. So the homeowner can pay us back at any time within the 30 years. It's a one-time paid in full lump sum. This really has helped us with serving underbanked, underserved populations. So there's no DTI requirements, there's no income requirements. We're able to help the entire credit spectrum because it's really an equity-based product. And so that's really helped us break into areas of the country and underserved populations and help the underbanked.
Excellent. Well said. And that's kind of a great primer. Lots of folks who are watching today are coming to the conference and they kind of understand this, but it really is designed to be an introduction. So let's meet our final panelist. Dan is from HomeTap. Tell us about what you guys are doing and paint the picture for the audience.
Thanks for having me, and great to be here. Excited to see everybody in Austin. Yeah, so HomeTap, fintech company based out of Boston, really with a ambitious mission to try and make homeownership less stressful and more accessible. And really, like the focus from very inception here was on the homeowner first. So we wanted to try and bring simple, straightforward products to bear that can help achieve that vision for homeowners and sort of back that with the education necessary for them to make the right decision about how to best use their home equity. The flagship product for us, as with the other folks here, a home equity investment, which I think Jordan did a good job of sort of explaining to everybody here. I'd say the one nuanced difference between sort of our products and other ones here are where some folks take a share of home price appreciation. For us, we're getting a fixed percentage of that home value, so that stays sort of the same throughout. We found that to be a very simple message that resonated with homeowners and made it much easier to sort of explain as we had those conversations. Beyond that, we've also put a lot of work into building out a suite sort of beyond the financial products themselves. So we recently launched a home equity dashboard, which homeowners can use to better understand their home equity posture, understand the various financing options they have in the home equity investment space, but also in the home equity loan space or the home equity line of credit space, and use that to make the right decisions around how they want to fund their daily needs. Oftentimes folks are using these products to pay down debt, start a business, buy a second home, fund an education, but often it always comes back to finding a way to take this illiquid asset that is their home and provide liquidity out of that. And so we thought that this dashboard product was very complementary to these HEIs and sort of presented that simplicity in a way that folks can draw off of and make informed decisions.
Excellent. All right, gents, all great overviews. I think where we are now is trying to understand how the various products help the end user. And then we'll get into, you guys and investment and collateralization, and is there opportunity for investors and all that part of it as well. But this has been an idea that's been around for a long time, being able to access the equity in your home. For most Americans, it is their number one asset, the equity that's built up in their home. Now, just so you think it's not brand new, back in the 1980s, I first got my real estate license in the 1980s, and at the end of the 1980s, my dad, who was my broker, and I started doing equity share agreements. Back then, there were not really those kinds of loans, so we had non-related co-borrower loans, and an equity share was the idea that an investor would help with the down payment, and the person in the house, the occupant, would make the monthly payments, and you can see all the challenges with that. But it was a really interesting way to get business from a real estate brokerage point of view and to help new people get into the market. Affordability, of course, is on everyone's mind. So we're going to talk about how these HEI products can help folks. And you hit on one of the things about this is it's not a loan. There still are home equity loans, and some of you guys are actually in that business and certainly have been. And the idea is if I've got, equity in my house, I can sell. That's one way to get to the equity, but I don't want to get rid of my house, so I can get a second mortgage with some cash out perhaps, or I can refinance my first mortgage. And of course, rates today are impacting that. Or I can look to one of the products that you guys developed to maybe not have a payment. So let's talk about that first, the shared equity model that you've got, we'll call them an owner of the property. And you can tell us whether it has to be owner occupant or if an investment property would work. But an owner of a property, they want to get to their equity, and they maybe have some of the challenges like their credit or their income, right? You have borrowers that are have this issue when they are in retirement, say. So let's just talk about how some of the products work, specifically in terms of are you sharing future appreciation? How does that work? And we'll start again with you, David, and just take us through what your product set looks like.
Yeah, and I appreciate the way you framed that, because we have a little bit different distribution model than most folks. We believe that these products should be sold on a needs-based selling basis, where you have someone that you have a trusted relationship with that's bringing you financial solutions. So initially, we were distributing through all forms of registered reps, RIAs, in some cases insurance agents, but folks that already had a relationship with that homeowner, because we felt that the cost of direct to the consumer and building trust is very difficult and expensive. So that's where we started. And with our product, we are similar to Point in that you can call it a discount. We take a share of everything over 70% of the initial home value of the home. So I know you've got a percentage of the whole home or a discounted. But to be candid, the pricing to the consumer from an investor, all the investors are looking for basically the same IRR. They want the same return on their money. So whether it's us or Point or Unison, they're looking at what's going to drive their IRR. So from a pricing standpoint, and I'm not sure how important pricing is. I know that consumers believe they want the best price, but they also believe in getting advice from people and trusting that advice. So pricing isn't always the key factor. And our product initially, and we still have this in our portfolio, our core FE product does not have a terminating date. So we don't have any, on our primary initial product, we do have a new 10-year and a new 30-year. But if you're marketing through financial advisors, you have to be compliant with FINRA, and you really can't refer this kind of a client without having with a term on it, whether it's 10 years or 30 years. So we're now expanding in our B2B into working with mortgage brokers as our partners as well, for the same reason: trusted relationship, needs-based selling. So I'll cut it off there.
Okay, good stuff. And, again, there's different answers to these solutions. I know that some of you have a requirement for a credit score, and some of those requirements are pretty low, right? But you want to make sure that I guess we can talk about what the risks are. If they have a loan in place, and this isn't really a loan but a lien, and there's no payments, but there is risk of foreclosure and those kinds of things. Jim, same thing. Take us through what your products look like and what they're designed to do, and maybe how they differ from what else is out there.
Yeah, our product is in some ways similar to HomeTap's product. We don't share the home's change in value. We share, we get a share of the entire home value. We think it's a simpler structure. We don't market through channels like David does. We're 100% direct to consumer, and we're kind of the new kid on the block in terms of the larger players, but we've already originated 10,000 contracts through that channel, and growing very rapidly. Our customers are typically coming to us because they're trying to get liquidity for the equity in their home, and it's challenging. Some people have different types of income. It's not W-2 income, or they simply have a lot of debt on their household balance sheet and unable to qualify on a DTI basis for a loan, or their FICO score is too low. And we've designed our product specifically for those people. And our entire platform is engineered to serve what we call a debt relief customer, somebody who's seeking a way to pay off debts that they've accumulated over time, high interest rate debt like credit cards, things like that, personal loans. So we take credit scores as low as 500 on the FICO score. We don't even underwrite the income of most of our customers. We do an income underwrite if they're below 550 in FICO, but otherwise income is not. We're really underwriting the home as an asset, and that's what you do with equity. This is an asset-based underwriting, and that's where equity differs from debt. I mean, none of us invented equity financing. Equity financing has existed in the world for a long time. And if you look at the utility there, look at corporate America. Companies can raise money by either selling bonds, that's the debt market, or selling stock, that's the equity market. Well, the corporate debt market's about 12 trillion in size. Corporate equity market, i.e. the stock market, is about 40 trillion in size, because there's an awful lot of utility in being able to raise money without having to service debt. For some reason, many years ago, when I first introduced to this idea, I always thought, wow, why has this never been available to residential homeowners? The only kind of equity financing you can get as a residential homeowner was the proverbial rich uncle who might help you buy a home and give you some equity, right? It just didn't exist. Nobody had ever brought it in. But it's the concept is not new, and it should exist there again, because there's a lot of utility here. So we help people that can't get a loan, or people that simply don't want the burden of an additional monthly payment. We provide a lump sum of cash. There's no interest. There's no interest rate. It's not a loan. We share part of the equity in the property when they sell or buy us out. Our contract has a 10-year term, and our customers are typically using this as a bridge. They're not, they don't really need more than a 10-year term. They're thinking, I need some money to get me back on track. I've gotten myself into trouble. Life happened, death, divorce, medical problems, job losses, things like that, where people that were solid citizens find themselves kind of upside down. And an equity infusion is the the antidote. They pay off a bunch of high interest rate debt. We don't report to the credit bureaus because we're not a loan. So credit utilization drops significantly, and the homeowner's on track to recover their credit score because the remaining debts are now more manageable for them. So this is a chance that's a very frequent path for our customers. We, the first act is we pay off a bunch of debts with the money. The second act is their credit score can recover considerably, and then their cost of living goes down because all financial products are driven off credit score. So we put our homeowners on a path to success.
Love that. A lot of different ideas in there for sure. And, part of the challenge that everyone has is explaining this, because I understand borrowing and making a payment. But, on your site, for instance, I know that folks can put in their estimated value of their house, what they owe against it, and you pretty quickly come up with, hey, here's the range of what you may be able to, borrow. Again, not directly being a loan. But love that. Now, Nick, you talked about, analytics being at kind of the core of what you guys do, and you have a broader offering. You see the opportunity here. But as far as it relates to HEI, take us through what your products look like and where the differences might lie.
Yeah, so very similar product to Jim's product at Unlock and Dan's product at HomeTap. The broader version of this that I like to explain to people who haven't heard of this before is, imagine a person called Steve who bought their home 20 years ago or 25 years ago for $200,000. And now the home's probably worth $1 million easy. They have a lot of equity in their home. But some Steves in the country are tremendously house rich, but also cash poor at the same time. And they, as we all see economic stats, like household balance sheets are really struggling right now. Credit card is at all-time high. And like Jim explained, there's a tremendous need for people who are paying these 25, 26, 27% APR on their credit card debt that want to tap into the equity of the home, but don't have a credit score that's high enough to be able to get a HELOC easily. And those people end up finding a perfect solution with us, where they're able to eliminate their credit card debt. And like Jim explained, because the investment we make in their home is not recognized as a debt, their credit score improves dramatically. And that's when we originate two kinds of products. On our portfolio business, which is the wealth of me, my friends and family offices I work with, we originate a 5-year product that shares the change in value of the home, shares the value of the home, similar to HomeTap and Unlock. And then we also are a forward flow originator for a 30-year contract that shares a change in value of the home. So for homeowners coming to us who are house rich but cash poor, and they can either choose a short-term refinancing where they improve their household financial health and refinance into a HELOC or a proper first lien after a few years, or they can choose to the 30-year contract and wait for a while.
Excellent. Well, I think flexibility is the key to this theme, that it really is the use that they have for it. It's, if you're going to originate a mortgage, well, that's, forever kind of. And here they usually don't think about it that way.
And to your point, to your point on how we use analytics. So we are recognized as the most accurate home price forecast in America. Last year, the home price predictions we published, benchmarked against Zillow, Redfin, Fannie, Freddie, CoreLogic, Goldman, Morgan, was not just better, directionally better, but within a quarter basis point of the actual home price projections. So we obviously help institutional investors who want to invest in home equity, not just through home equity contracts, but direct home equity through single family acquisitions and others at scale, access these analytics. But these analytics also give us a view of every single household in the country. We monitor all 144 million addresses. And if you can tell me a name, I can tell you their address, I can tell you how much equity they have in their home, and I can also probably tell you their phone number. And that's how we market to them. We directly go to the homeowner and form a personal relationship with them when, if they need to tap into their home equity or, they need to tap into financing, we can help them out.
Excellent. So appreciate, so far you guys have all kind of explained how it is you get to market, and that's going to vary. So Jordan, at Point, it's similar. You guys will lend what, I mean, not lend, get the homeowner up to $500,000. Take us through what your products look like and how you get your clients.
Yeah, absolutely. So a lot of it is the direct consumer, direct mail, or the classic like search engine optimization and keywords that a lot of homeowners find us. A lot of it, though, for the past few years have just been word of mouth, and we've been getting just overwhelming demand from homeowners via word of mouth. And I'm really proud of where the product has come and the asset class has grown. But to answer some of your earlier questions on just basic contract features, so we'll work with any 1 to 4 residential property, owner occupied or non-owner occupied, assuming it meets our criteria for the type of home and the geography. The large majority of our homes are owner occupied. Mentioned it's a 30-year term, sharing an upside or downside. The default events are all very, very similar to a mortgage. So pay your insurance, pay your taxes, pay your mortgage, pay your HOA, all things that can get you in trouble with a mortgage are also default events under our contract. And there's a 30-year term, so pay the contract before the 30 years are up to avoid that default event. If the homeowner is selling or doing a cash out refinance, we do require payback as well at that time. But until then, no monthly payments. The homeowner can decide when they pay us off. And then we've also never had an instance where we've been the foreclosing party. We've been party to foreclosures, but I think that's really worth calling out just because we're a partner in the home and that we haven't had to foreclose on a homeowner. Like I mentioned earlier, our product is very similar to everything that's been described here. We're sharing in the home's future appreciation or depreciation. The homeowner's getting cash, and then we have that upside or downside secured product. And then for the home value, we do apply a discount. So when we start the appreciation, it's from the discounted values of the home, similar to the other products. And then we also have a cap, so a maximum the homeowner would ever have to repay. When we started the company, we went to different consumer advocacy groups, we went to the CFPB, and we said, hey, we think this is the product we want to launch. What do you think of it? And the feedback we got was, we really should have a cap. And so since then, everything we've done has been really forward homeowner focused, and we've kept the homeowner in mind. And if you change the levers to our product, like the discount and how much we're sharing in, it's very similar to all the other products. But I would just say adding the 30-year term, then everything we've done has been really optimized for the homeowner and the consumer experience, also keeping the investor in mind.
Got it. Great. Excellent stuff. All right, Dan, at HomeTap, what's different? What do you guys see, and how does it work, and how do you find your clients?
Yeah, so I can take us home on this one. Again, similar to Jim and Nick. So for us, we are providing capital in exchange for a fixed percentage of that home value. So rather than getting a percentage of appreciation, so it might be, 0.30% of a future appreciation, for us, we may have 5% of the home or 7% of the home. Then that's locked in at the time of investment. We also have a cap, right? So for us, we have a 20% IRR cap that we make sure aligns with homeowners. So a similar concept with Point. And then one unique feature of our product here is that we have a down share as well. So in instances where there's depreciation of the home, we actually take a smaller percentage than in instances with appreciation. We think that brings better alignment with the homeowner and allows for us to sort of reemphasize the idea of an investment as a partnership, which we try to reflect in our product and our processes and in the people that go about and do their jobs on a day-to-day basis. I think what's been interesting here thematically that's come up is, just like all the other folks on the call, we do tend to find quite a bit of product market fit with folks who have a pay off debt use case, who are looking for this to pay off credit cards or address other sort of accumulated debt that's built up over time. But to the point that I made earlier as well, what we found, which I think is extremely promising in terms of the broader sort of expansion story for home equity investments in the future, is that with the right level of education, with a simple enough product, this has a broader market than just that. So we see a quarter of our folks coming here to try and make changes for renovations. A lot of people are paying for education. They're diversifying their portfolio. They are helping sort of pay for the needs of family members. I know it's been getting a lot of press recently, this idea of a sandwich generation that has to pay for elderly parents who are sort of aging in place, as well as paying for children. And so, for us, our average FICO score is actually sort of right around the 700 mark. So you're seeing folks who are coming in, who again have that debt use case and have sort of run into issues and are trying to build out of that. But you also have folks with pristine credit profiles who just don't want the burden of monthly payments and see this compared to any other sort of traditional loan product as a viable option and actually the best option for them. The other thing that sort of gets unspoken here, because you're spending so much time thinking about the trade-off on home value, is the sort of transformative nature that this has to an individual homeowner's monthly sort of personal P&L, right? So by virtue of not making those monthly payments today, they can take that sort of opportunity cost that's inherent in a loan and put that back into addressing their daily needs, putting that into savings. And so they can find other avenues for wealth creation while also tapping into their, you know, main vehicle for wealth creation and sort of sharing in that with the investor. So we find that to be extremely promising and sort of see that as another step towards this becoming a mainstream asset, not only in the capital markets, but also in the consumer markets as well.
Excellent. Well, interesting about the credit score, because as I kind of researched each of you guys, and it looked like, you know, for 500 or 620 is my credit score, asset based. What would you be worrying about? Well, it's not necessarily people that aren't lendable. This is a different product. It's a different choice. And I think you guys are really starting to do a good job of explaining that to the world. And I think that's, you know, a couple things around that. I do want to say that if you have a question and you're watching for these gentlemen, just go ahead and type it in the Q&A. We've got at least one of those we'll get to here in just a second, but we'll open it up to audience questions in a minute. I do think that the cost factor is interesting because let's face it, as a business, you guys are after an ROI, either for investors or yourself or whoever it might be that is funding this endeavor. And it's patient capital, right? Not all capital is willing to wait. So maybe we can speak to that a bit. But the actual internal rate of return looks pretty good. So take us through that, if you would. Maybe we'll start backwards and start with you, Dan. And you know, what is it that maybe not just what the costs are, but how is that perceived? What's the pushback, if any, that you get? What are the selling points as you're talking to these folks?
Yeah, happy to try and field this one. So I think, again, it's important to look at this from the homeowner lens first, right? So at the individual investment level, the IRR on one of these investments depends, right? And the cost depends. It's going to be dependent on the timing of the settlement. For us, it's a 10-year product. And, you know, there's quite a bit of variation in terms of the individual property level IRR. If you settle in year 1 versus you settle in year 10. And if we're point where it's a 30-year product, that's, you know, even more variation during that period of time. So, you know, homeowners could end up paying us more, or they could end up paying us less than the traditional debt products that are available at that single, you know, homeowner level. But we do recognize that we're providing flexibility to our homeowners. They have the ability to settle at any point in time during that investment. There are no monthly payments that they're making. You know, there is no sort of concept of principal that has to get repaid. And so in exchange for that, there should be a premium that gets paid to capital in order to take the risk that's associated with that. And so then when you zoom out to the portfolio level, I think the point that we've tried to make to investors is that overall, the residential real estate market here is extremely resilient. So outside of the great financial crisis, there really have only been, you know, 2 periods in the last 50 years where we've seen home price depreciation, and those have tended to be short and sharp. For the most part, you do tend to see modest appreciation over 10, 15, 20-year periods. And so the trade-off here is, while an individual homeowner gets flexibility at the portfolio level, just like for RMBS for traditional mortgages, that diversification is going to give you quite a lot of protection built into your portfolio. And so when you add all those factors up and you think about pricing there, we get this nice trade-off and alignment where homeowners get individual level flexibility, but we can feel confident as we provide this to investors that you can underwrite to kind of mid-teen IRRs at the portfolio basis, and feel pretty comfortable that you're doing that in a diversified way that doesn't have outsized risk compared to other residential real estate products that exist. So we're very happy about that trade-off, and we think that we're going to be able to build a stronger capital markets presence on the back of that alignment that you build with the homeowners.
Excellent. And of course, in some cases, like in your case, you don't have to wait for a sale or a refinance. When they have the opportunity, they can buy you out. Is that how it works?
That's right. So yeah, I mean, we do see the majority of settlements coming through cash out refinance or a home sale, but there are certainly cash settlements that also will happen. You see that particularly with these, you know, business use cases where folks are trying to get working capital to get a business off the ground or to get that started, or in diversification where they're trying to sort of spread them out sort of through other assets. And so those are interesting opportunities for us because those really are sort of bridge use cases where homeowners are taking that capital from a personal asset, putting that into a business, and then sort of returning that back to try and sort of make the best sort of trade in terms of funding their business needs.
Yep. And there's the innate psychology that if folks know, hey, at any time, no prepayment, you can get out of this, whether they use it or not, that's an advantage. So, Jordan, what about at Point? Same question. The cost you're seeing, maybe where, if any, pushback or objections that you guys are dealing with regularly to educate folks about this. Take us through that with your product.
Sure. Yeah, I largely agree with what Dan was saying. You know, the majority of our company or our customers come to us, they have other debts they're looking to pay off. And our homeowners, when they're considering financial products, it's typically fast cash, like credit cards, personal loans, medical debt, things other than 20% plus, interest rate range. And our product, we have the cap. And so it's extremely important that we educate the homeowner on that. So even at the most expensive to the investor, we'll be earning about a 20% IRR. Right around there. So what that means for the homeowner is even at our most expensive, we're still cheaper than a lot of the other debts like credit cards, personal loans, medical bills, things like that. So when the homeowner sees that and you just do a cost comparison, and like Dan was saying, it's all based on how long they hold the product out. But we're still a much cheaper product than a lot of the other alternatives with substantially more utility because there's no monthly payments, and homeowner can pay us back even without a sale or refi. Like we get a lot of small business as well. We get folks who are good startups and have liquidity events on their own, so they pay us back all the time. It's worth also calling out from the investor side. So even though we have a 30-year term, we have multiple warehouse providers lending to our investors. So our investors are able to get leverage on the product. We've also done 3 securitizations now, which has been another great source of leverage and liquidity. So even though it's a 30-year term and homeowners are turning over every single day and paying us back, but we also do have more liquidity on the back end via warehouse facilities and securitizations that have performed really well, and we're very proud of.
Well, and every day it's more proof of concept, right? As you guys are building up the numbers. So that part is exciting too. Now, Nick, let's talk about the fact that you guys have this access. I mean, we'll talk about valuation, I guess, on a bigger topic here in a minute, just appraisals or whatever. But you guys you're keyed into this very much, so you can kind of identify who the prospects are. But what is it that you come up against? Are people concerned about the pricing of this or the uncertainty of where the home's value may go? What does that look like for you guys?
So fundamentally, for people who are, tremendously house rich but cash poor, and like Dan and Jordan mentioned, have debt in their lives that's costing them way north of 20-25% APR annually, it's a perfect solution for their financial health, right? They get to tap into their equity of their home to essentially settle all the rest of the debt in their life and perhaps some more, and get flexibility from anywhere from 5 to 30 years without any monthly payments whatsoever to settle whenever they want. The cost of the product right now, the caps are similar for us as well. It's a 20% cap, but at a portfolio level, the returns are in the mid-teens, which is slightly more than the HELOCs, given that there is no monthly cash flow in this product whatsoever, and way cheaper than other debt forms that consumers are trapped in right now. And that's the level at which there is alignment between the needs of capital markets and the needs of homeowners. Over time, because of tremendous efforts at Point and Unlock and HomeTap and others, as securitizations get to scale and capital markets, finds more trust in the product and the track record of this product, the cost of capital will come down to make it as friendly for homeowners as possible. And I think fundamentally we have a good equilibrium right now where the needs of everybody is being solved.
Yeah, good stuff. I'm looking forward to the conversations and panels around that at the conference for sure, which is coming up in Austin, Texas. Yeehaw. All right. Jim, I think that, when you've got a long history in this business, and Nick mentioned, HELOCs, The typical home equity line of credit, the part of the value proposition is you're only paying for it when you use it. Although we could all argue that, hey, that's going to count against you when you're qualifying for other loans and so forth. But it can be taken away at any time. So there are folks that are sitting on unused HELOCs. I'm guessing people don't take advantage of this product if they don't have a need for the capital right now. Is that what you're finding?
Yeah, I think that's right. I mean, if people have a smaller need for capital and they want to use our product, they'll just take a smaller deal. Like when a customer comes to us, we'll do an initial underwriting and enable us to tell them how much cash they could qualify for, but they're certainly not required to take that amount, right? The maximum amount will result in a certain share of the equity in the home. If they want to take half that much, they would give us half the share of equity. So the smaller or the larger the payment that they get from us, the smaller or the larger the share that we get in the home. So the customer can choose the deal size that they want. And thinking about HELOC money, most of our clients cannot qualify for a HELOC, so they don't even have that option.
Okay.
But you're thinking about the cost of funds, and we have the same cap that everybody else has. Essentially a 20% annual cost. So the homeowner can never pay more than 20%, and they're typically paying off debts that are costing much more than that. They're
Right.
paying off credit cards or personal loans that are in the mid-20s, even into the 30s, and require current payments. Whereas with this product, all the payment is deferred to the future, and the ultimate cost is lower. And the longer you keep the money, the lower the IRR is. So, for example, if a home value rises by 3% per year over the 10-year term of our agreement, and the homeowner keeps the money for the whole 10 years, the money winds up costing them about 10.4% per year.
Okay.
That's actually lower than the HELOC rate that our customers would get if they could qualify for a HELOC because of their credit. They'd pay more for the HELOC and have to make the monthly payments, but most of them can't get the HELOC. So this is it's a really useful choice for most people to have. And look, if you've got a lot of money in the bank and you've got access to home loans and things that you can lock in lower rates, you probably should take those products unless you're really adverse to taking on another monthly payment. But we have a lot of high FICO customers too that would prefer the utility of this product where they don't have to make the payments.
Yeah. Good stuff. All right, David, I had to go to you first, the first two rounds. So this time you get to back cleanup. You've got to hear what everybody else says. Anything you want to add to this part of the discussion?
Yeah, there's a couple of things. First of all, I think we all have to acknowledge that we're not investors, we're matchmakers, right? I mean, we're not putting our capital out there. I know there are funds that are putting out their capital, but they have LPs that are investors. So, matchmakers, we all have caps because, the investors felt that they needed to have caps, right? And we all priced roughly the same IRRs. So, all that, we are matchmakers, and we're the two loan products we're introducing actually are called matchmaker, but we think that aside from the the credit repair, that I think we need to talk about income. So much of the business that we did, and I think we need to talk about income, and we haven't said anything about the fact that at least in our product, and I think probably in the others, these aren't taxable events when you get that money, right? So when we're working with financial planners and we're working with insurance companies, our challenge has been insurance companies can't hold this asset on their balance sheet. It's just only in a securitized form can they do that.
Right.
So, we have insurance companies that love the product because, we can deliver to them top line revenue if someone takes money out of their home and purchases an annuity, as an example, to create income. So a lot of our business came from financial planners that were working with clients that are in the drawdown phase of their retirement and, drawing down taxable investments, right? So now they have to pay taxes on that. And rather than pay taxes on that, they, use our product, and there's no tax on that. It doesn't affect the cost basis of the home. And it's a great alternative to, reducing to reduce the taxes that they have to pay on their assets. And our contracts were much larger. I think our average was about 300,000, but we were originating in California. Home prices are higher. And there's a challenge, there's an origination cost for every one of these contracts. So, with smaller contracts, it's hard to make money. But, those are the things that we all have to deal with. So, and I'd say my last point is that none of these investors are looking at long-term liabilities. They're, any of these investors are 3 to 5 years and they want to be out. And, many of the contracts that have terminated, fall into that, 5 year or so bucket. So even trying to get pensions to do this for their pensioners is a problem because they still want the same returns investors have. So I'll cut it off there.
That's great. A lot of great points. Boy, I wish we had an extra hour. Hey, let's get to some questions. There's some good ones. I don't think they're going to take that long to answer. Mark says, with HEI, what happens when repairs are needed and the owner is out of cash? Does the investor step in to pay that to protect the investment? And we talked about the IRR hurdle, so that's good. And anybody that wants to take this, what happens if the property has a challenge and do you ever step in?
I could take that. So the investor under our contract does have the right to make a preservation payment. It'd be a very rare scenario where the investor would want to step in. More likely, we would work with the homeowner, see if there's any alternatives. We call it a repoint, where the homeowner would get a new point agreement. It would actually pay off the old point agreement, but then give them more cash to make repairs. We want to know the extent, potentially look at insurance claims. We are a named insured on all of our homeowners insurance policies and do have a robust force place insurance policy as well. So there are options where we can still work with a homeowner or potentially find them an alternative if they do run out of money and there is a large home repair needed. It's small, and your normal wear and tear home repairs or appliance go out, we would not step in those cases.
Anybody have a different answer for that? All right. Another great question would have been my first question is, what about investment property? Is this only for owner occupants, or would you consider a single family home that was in somebody's rental portfolio?
We do a lot of rental properties and second homes, vacation homes.
Same with us. We love investment properties in our portfolio fund. Like Jim mentioned before, we are really underwriting the equity of the property more than anything else. So if there's equity and if they need cash, we're happy to help out.
Yeah, same here. The only limitation is we have a 10-year term on that for investment properties.
When
We
you
work with
talk about
investment
all the
properties.
uses for people's capital, certainly one is just like your investors, they want to double down. Maybe they want to use that to invest in some more real estate, which we'd be all for. You had a point, Jordan?
Yeah, we work with investment properties as well as owner occupied. I'll just say with investment properties, it's a little bit of a different risk. In a down market or something goes wrong, the homeowner is more likely to sell their investment property first. So we take that into account with underwriting and require different equity levels or more of an equity cushion when working with investment properties.
Excellent. Okay, here's a question about foreclosures. I mean, I would think that would be the risk. It's not a loan. They're not making payments, but they have a first, arguably probably at a low LTV. How often does that happen? And what happens when the homeowner goes into foreclosure?
Yeah,
Anyone to take-
we've never foreclosed on a homeowner ourselves. The vast majority of foreclosure activity is coming from the senior lien holder, i.e. the mortgage lender, where they're not making the payments there. In which case, we can sometimes help out depending on circumstances. We have the ability to make a protective advance to actually bring the loan current and help the homeowner sell the home in a non-distressed sale rather than have it go to foreclosure.
Exactly. Like Jim mentioned, in a foreclosure, our incentives are aligned very strongly with the homeowner. If it truly does go to auction and the first lien, sells it, we'll probably not get anything, which is why we are aligned with the homeowner to protect their equity and do everything we can to protect them. That's why we've never foreclosed as well. One of our properties has been in a first lien foreclosure, and we work very closely with the homeowner to find a loophole to extend the process for 6 months, help sell the property, which was also really large, but it was a $3 million property in Tennessee, which is kind of hard to sell. And then the homeowner cashed out and was able to stabilize their personal finances as a result of that.
Yeah, and
Excellent.
if there is a foreclosure, it really varies by state. So you really can't give guidance other than every state has their own rules. But it is a lien on the property, and it does have a preference above non-secured credit. So that's pretty general, but every state has different rules.
Well, the whole idea of having a portfolio of these products is, you may have one or two go bad, just like in any lending product, and that's just part of the cost to do. So, what about valuation? So, are there appraisals required, or Nick, you guys already know well enough about the value? What do you do in terms of establishing value to make your decision?
Yeah, so fundamentally, valuation, what we focus more on is agreeing on the valuation methodology. We have originated home equity investments properties where we required an appraisal at and at the end of the settlement. And we realized it was too cumbersome. It was slowing our origination process down. So now we use a desktop underwriting valuation process. But we agree with that process. It triangulates data from public sources as well as local sources to make valuation as seamless as possible, but also make it as transparent as possible. And we also give the homeowner the right to challenge the valuation and a process to, help them get to a better conclusion if they feel there are better data points.
Anybody have a different answer?
Yeah, we're using mostly appraisals, but we do have hybrid appraisals and other products available. A lot of this, it's important to understand, a lot of this is investor driven. Like if we were to say tomorrow, hey, we're going to use AVMs for everything, I think we get a lot of pushback from investors. Investors still to this day like to see that full, 1004 type appraisal.
Yeah,
you bet. Okay, final Jeopardy. There's a couple of more questions in here, and I would say these gentlemen are going to be with us in Austin shortly, so you can definitely track them down. And again, really appreciate all the panelists to take time to share today. This has been super, super helpful. What about securitization? So you mentioned a little bit about that, Jordan. Do we think that there's going to be a future market for this that's going to look different than today? How much of your exit strategy is based on a secondary market?
Yeah, I think for securitization, for our investors who have aggregated contracts, like we've originated over 11,000 homeowners now, and for our investors who've been aggregating these on their balance sheet, securitization is a great option for liquidity. There's been multiple warehouse providers that have come into the space, and to be able to pay off the warehouse providers, recycle capital, and we're in the really early days of building out the securitization market, but it's definitely a great option for our investors who own the assets.
Anyone else have a comment on that?
Securitization is probably the greatest source of liquidity that we'll see as an industry. We've been able to get rated transactions done. There's been a few different providers. HomeTap just did their first rated deal. We're getting ready to do our third. Points done some. I mean, this is where it's going, and over time, what'll happen is the execution will improve on those ratings, and we'll move up in terms of, there are certain rating agencies that you typically start with when you have a new asset class, and then there's other rating agencies that kind of are followers, and they'll but eventually you'll get this product rated by all of the major rating agencies at better and better executions, and and that will lower the cost of capital. And I would expect, I know for certain, that Unlock will pass that lower cost of capital on to the homeowners. I would imagine everyone else would as well. So that's when you start to achieve real mass adoption and scale.
Well,
Yeah,
you guys
that's
are pioneers.
Yeah.
Another point?
No, that's absolutely true. When I spent 2 hours with Lou Ranieri in 2015, and I asked him how long it took for him to do his first securitization, and he said 12 years. And I thought that I was on the right track, but it's been a little bit longer. But that's what we need for consumers.
All right, good stuff. Well, hey, that wraps up our hour. Again, big virtual thanks to all the panelists. The event happens the 5th and 6th of September in Austin, Texas. and tickets are still available. It's going to be amazing. Lots of great stuff. If you go to imn.org and look up the HEI event, you can see the complete agenda. And we'll see all you guys in Austin. Can't wait. Come up and say hello to us, and we'd love to talk to you. Steve, we'll hand it back to you.
Thanks, Robert, and I hope everyone found the discussion to be of value. And I'd like to thank David, Nick, Dan, Jordan, and Robert for all the work they put in and for sharing with us their time and expertise. We'll be sending out recordings for everybody who signed up. If you're here, or I guess if you weren't here, you wouldn't hear this. So for those who aren't here as well. And as Robert said, September 5 and 6, feel free to sign up for the conference. And thanks all for attending, and have a great day.
Thanks, Steve.
See you in Austin.
Great.
Thank you.
Thank you.
Thanks, everybody.
Thanks
Thanks,
all.
everyone.